Hey, thanks for tuning in to the Art of SBA Lending. Today on the podcast, we have Kevin Riffey. Kevin is EVP and SBA Director at Bank of Central Florida. Kevin's been around in SBA for a number of years, and he's a fan of the podcast. In fact, he wrote a comment on one of our posts the other day that drew some attention, so I wanted to invite him on to discuss that, as well as learn more about him and what he's doing over at Bank of Central Florida. So without further ado, let's get into it. Hey, Kevin, thanks for joining us today. How you doing?
Good, Ray. How are you?
I'm doing good. Well, actually, I'm doing bad. I'm very sick. My voice is sounding very odd right now. I don't know if you noticed that. And I'm hopped up on all sorts of medicine, so I'm liable to say anything this one. So it should be
Okay.
interesting.
Well, we'll have a fun time then. Hopefully, it's something good you're on.
Yeah, well, I got my tea right here, the herbal stuff.
Okay. Good.
Are hot. That's hot.
Don't burn your face off.
Kevin, you've been in the Florida market for a while. You're an SBA director at a bank. That's why we wanted to have you on. I also saw you wrote a comment on one of our other posts that drew attention that I wanted to kind of have a spirited debate with you later. But before we get into that, I just wanted to get your background because I don't know it and I'm interested. I say this question to pretty much every guest because SBA is such a niche industry. How'd you get into it?
Yeah. I mean, it's something I never really envisioned going straight into. So by way of background, I have an undergrad degree in accounting. I went to grad school, got an MBA, and was kind of just interviewing during my second year of grad school, trying to figure out what I wanted to do. I was, I don't know, 23, 24 years old, trying to figure out my path for life in my career. And doing the consulting companies and banks and even some distribution and manufacturing companies, interviewing with them. And I met a guy with a regional bank who was quite interesting. We kind of hit it off during the interview just because he was an Alabama guy and we started talking about football and whatnot. And he was a recruiter for the regional bank and started talking to me about commercial banking. It seemed really interesting at the time to go try to figure out how people make money, go into these different businesses, make them loans, help their businesses grow or start businesses. So I went down that path originally and went through their management associate program, which was about an 8-month long program. So came out of that one in, I guess it was February of 1996 and moved to Florida. And I was in a kind of a middle market commercial lending group here in Tampa as a junior lender. So I supported 2 other lenders. Learned a lot about commercial banking at the time, doing underwriting, annual reviews, going on client calls, prospecting for business, et cetera. So had 2 really good mentors there, learned a lot from them. And then about 2 years later, I got a call from a recruiter about an SBA opportunity. Didn't know what SBA even was. I mean, the credits we were doing were between $5 million and $20 million at the bank. Had some conversation with the recruiter and thought that it could be a nice step for my career. So I joined GE Capital in late 1997.
A GE guy.
Yeah, I'm a GE guy. There's a lot of us floating around, and it's interesting because a lot of the guys are still in the industry. I can name some names. I mean, I'm sure you know them, Chris Hearns and Charles Rowe, Marty Ferguson. There's a lot of those guys running around that, I've known for the last 23, 24 years, and we worked together back in the day. So anyway, literally day one on the job, they handed me a 3-ring binder with the SOP and said, learn it, live it, memorize it, that kind of stuff. And that's really how I got into it. And, as they say, the rest is history.
Every story is different, but there's one common thread, and that's that no one picks it. It picks you.
Yeah.
People fall into it. It's so funny.
Yeah, I was hungry. So, I was, like I said, I was a junior lender. I was kind of supporting these 2 lenders. And, when you're 26, 27 years old, you think you're hot stuff. You think you know everything. And I was ready to go out and find my own deals and have my own book of business. And the bank that I was with at the time was relatively new to the Florida market. So there just wasn't a lot of opportunity for me to move into that role for myself at the bank. And I I saw this business development officer role with GE Capital as a way for me to go do that. And certainly they provided a ton of opportunity and a lot of training. I think primarily GE, if you know anything about it, was really a sales organization, and we just happened to be selling SBA loans.
And I love that. And you don't see it as often these days, especially the training part of it.
Mm-hmm.
Not a lot of shops are willing to train new salespeople into SBA BDO positions. So you started out as a BDO, but at some point you kind of pivoted a little bit more towards management. How did that go?
There's quite a gap between, late 97 when I started as BDO, and then I would say 2010 when I started as, somebody creating and developing an SBA shop. So, and within that gap, there was, a lot of time as a BDO, both on the retail and wholesale side. I also spent 5 years working for, two different companies on the wholesale side of things, buying and co-originating SBA 504 loans.
Oh, so, really? What was it, Zions?
Yeah, Zions, and then Lehman Brothers.
I didn't know that.
Yeah, so we had a really nice run at Zions, and then in 2006, left there and went to work for Lehman Brothers. And I'm pretty sure you know the Lehman Brothers story. 2008, when my wife was 8 months pregnant with our second child, we all got laid off.
Yeah, everyone has a story about that. I used to work with a guy who worked there, Mark Gilson.
Yeah.
Similar type of thing. So, okay.
Yeah, a lot of exposure on both the retail side and wholesale side of SBA 7A, 504, a pretty well-rounded background, across all different aspects of SBA. So fast forward to 2010, I got a call from a buddy of mine who, interestingly enough, was kind of a mentor, one of our credit officers at the first bank that I worked for coming out of college. And he's still a friend of mine to this day. He called me and said, "Hey, I just took over as the chief credit officer for a community bank here in Tampa. And, our executives are talking about getting into the SBA business. You're the only guy I know that's in that business, that's been doing it for a long time. Why don't you come talk to us about starting up a shop for us?" And that was 2010. And I started up the shop for them and had a pretty good run there for a few years, and then moved over. And, I've moved around a little bit over the last, 10, 12 years, and built a couple of shops.
That's interesting because you made it sound so easy. Oh, we'll just start up an SBA division. Okay. You had a lot of sales experience and knowledge of the industry, but building and directing an SBA shop requires a lot of other skills that you probably didn't have at the time. You probably had to learn those on the job. I mean, how did you learn how to actually do everything?
Now, listen, I'd love to sit here and tell you I did everything, but I didn't. I mean, the reality of it is that I had a lot of help, and that help came from different parts of the bank. And it's the same way today. So, leaning on people that are in the operations department, leaning on people that are in credit. I've never built something where I came out of the gate and said, I need to go hire 6 or 8 people. I have to have a dedicated SBA loan officer or credit officer. I have to have a dedicated portfolio manager, operations manager, et cetera. My philosophy on building things is a little bit different, especially at the community bank level. And the way I do it is, let's come in and utilize some of the resources we already have in the bank to do reporting, to do underwriting, et cetera, servicing. And then we use outside counsel to close the loan. So we take some of that risk of doing SBA lending away from the bank by using outside counsel. We leverage some outside resources, and then you just build it that way. And as you start to generate revenue for the bank, then you start adding in pieces and making, and hiring people that are dedicated to the SBA business.
What about like when there's an SBA audit? As a director at a bank, would you be involved in that?
Yeah, but the reality of it is that the smaller banks, like community banks that I've worked for, you're not having an audit in the sense that we might envision an audit. It's not a file audit. It's more about the bank in general and the overall health of the bank that the SBA is doing. They're not coming in and saying, let's look at the last 20 loans you did and audit them.
Oh, okay. Yeah, that's more of what I'm used to.
Yeah, you're not, in the community bank world, in most community banks, you're not doing that kind of volume that you'd even be on the SBA radar.
Ah, That
Yeah.
makes sense. Okay. Interesting. So even though you were a director at the last couple of shops,
Mhm.
business development is still a big part of what you do, right?
It's kind of a player coach model. I've got some referral sources that I've been working with for the last 15, 20 years, and they still send me deals. I'm not going to sit here and tell you that I'm out pounding the streets all the time like a BDO would do, looking for new referral sources, looking for new loans, et cetera, because I have that responsibility of overseeing the direction of the shop. But yeah, I mean, I do a lot of that as well. And then it's the internal sources as well. So the commercial bankers, business bankers, other people within the bank that have SBA opportunities, they come to me, we screen them, and then we process them. It's literally a handoff. So we do training for our internal folks. Hey, here's what an SBA 7A loan looks like. I don't need you to be an expert, but I just need you to kind of understand generally what it looks like and why we do it. That credit elsewhere thing. Hey, if you've got a loan that doesn't fit our box conventionally, it may fit as an SBA loan, and let's discuss it. So that's how we do it. It comes to us, it's a handoff, and then we shepherd that deal all the way to closing, and then ultimately it resides in that commercial lender's portfolio.
Player coach. So you still get to act as a BDO on some of the deals, but you're also kind
Yeah.
of managing a team. So
Yeah.
um,
Yeah.
and you don't miss just being a carefree BDO?
It has its pluses and minuses. Um, that's an interesting question because certainly as a BDO, I remember my days where I was literally going out and just finding loans, and the package came to me. And back then it was the Form 4, Form 4I. They were all, it's different than the 1919s, 1920s today. And I would get a FedEx package and I'd go sit down with the client. It had all this sign here, initial here type stuff. And you'd have the client sign all that, you'd ship it back to the shop, and then somebody else would process it, and you were on to the next deal, essentially.
It's crazy that we were just 10 years ago, which is when I started, you were getting packages. Now I get 0 packages. How else has SBA lending changed in the last 10 years?
I don't know that we have enough time to talk about that, but for me, I think there's a couple of big things that have changed with SBA. Number one, going back to when I first started, there was almost a stigma attached to SBA. It was, lender of last resort. Oh, you had to get an SBA loan. Your business must be on the way, on the way down. You're one step away from bankruptcy or something like that. I'm confident that's changed a lot over the last, especially 10, 15, 20 years. That if you look at the way the capital stack sets up, in my opinion, an SBA loan is the next best option compared to a conventional loan. If you look at that compared to going and taking on hard money or private money or even equity, diluting your ownership in a company just to get capital, I think that an SBA loan is a much better option than that. Technology has been huge. You never probably had this experience, but when I first started, there was decentralized processing with SBA. So if you look at our state of Florida, for example, you have the 2 districts, South Florida, North Florida, and anything that had to go for processing that wasn't a PLP type loan, you literally put it in a FedEx box, all the tax returns, forms, et cetera, shipped it off to the district office. It would sit there for weeks, maybe even months before somebody picked it up. And the process was just very arduous.
So it was like USDA kind of, right?
Yeah. Yeah.
Okay.
Very much like that. But now when you look at the way things are today with SBA, and I'll go on a tangent here, and this isn't meant to be political at all, but I'm a firm believer that the SBA program is probably one of the best run government programs we have. You can point to any number of other government programs, and there's a lot of, I think, waste and a lot of maybe issues with them. But I give the folks at SBA credit for what they do. It's a very lean shop, and what they do to get money out on the street for businesses is just amazing. So
I'll be sure to cut that out and tag SBA so that they can see you saying that.
I believe that. I remember I was out in Arizona for a NAGL conference and was fortunate to sit with the person who at the time was running the processing center in Citrus Heights. And I talked to her, and she was telling me how many employees they had. And I said, you know what, it's just amazing how you guys do what you do with that few employees. She didn't have 300 or 400 employees. As I recall, I think it was less than 100. and what they were doing is just amazing.
I know, and SBA lending is up so big this year, and PPP and forgiveness and this and that, EIDL, like all of that. Like, I'm curious to see if their staff didn't triple. I mean, and it didn't. I'm sure it didn't, but it is amazing.
A lot of temp. It's been a lot of temp stuff is what we've noticed, contract and temp employees to help with PPP and then the increased volume in the 7A world.
Well, I agree with all that. I got in it 10 years ago, so you have a more robust view of it, but I remember exactly like you said, oh, I don't want to go SBA. Well, why? And then you talk them through it, and then they're like, oh, and I used to love that, actually. That was fun. Now it's so different. I'll add on what you said. The borrowers are more sophisticated, especially with the business acquisitions. These kids are coming out of like Harvard trying to buy businesses with SBA loans, and they know all the SOP rules. And it's cool, but it's also kind of annoying because they're like, all right, I'm going to do the 95-5 split. We're going to put this on that. I'm like, how do you even know all this?
Right. Well, I mean, a lot of them are, like you said, they're, maybe either current or former private equity guys that, they've found an avenue and a way to finance acquisitions. And it's amazing that they've done it that way.
Well, it's amazing, but I also kind of worry about it because the integrity of the program is always something that keeps me up at night, and people abusing it. And I mean, I don't think they're abusing it. Don't get me wrong, but like these private equity people are going to buy businesses. They're going to increase the profits, do acquisitions, increase their EBITDA to where they can sell it and make like a lot of money. And that's just something that people haven't done before on a widespread basis. That's like a model now.
And let's face it, that's part of the business cycle in general, whether it's, whether you do it via the SBA or you do it conventionally or you're doing it through your own money. I mean, that's just the way the business cycle works. And I think we all benefit from that, in terms of being in the SBA space and making those loans to those guys.
All right. So let's get into the meat here, Kevin.
Boy. Hey, I gotta say, all right, go ahead. It's not that controversial. It's not that controversial. It's really not.
No, it's not. And so we were on another episode of this podcast. I was talking to Charles Green, and he was saying something that we said was controversial, which is he doesn't pay referral fees. You commented you felt the same way about interest rates because a lot of lenders are trying to maximize the premium on the secondary market by charging the highest possible interest rate, and you thought that's controversial. And I wanted to talk to you about that because I actually have a different take on that. But before we get into it, I just want to give you a chance to just clarify what you were kind of saying or restate it.
Well, I don't know that I need to restate it. It's kind of a philosophy that I've had for quite a while now, being in the SBA space. Is maybe, it's a phrase that's been used quite often: pigs get fat, hogs get slaughtered. First of all, I want to say nobody's wrong for pricing their loan however they can. And, I'm a firm believer that, if somebody can charge X for a product or a service and somebody is willing to pay it, then it's worth that. So people that are pricing their loans at 275 over prime and getting full coupon all the time, somebody's paying that. So, I'm not saying that there's anything wrong with it. I guess my question is, when I look at it and say, when you price something at 275 over prime versus 225 over prime, what's the difference in yield to the bank when you're sharing half of that increased yield with SBA? So, and what effect does that have on the borrower? If you're doing $1 million loan and the borrower's paying 50 basis points more in a rate over 10 years, for example, what's that increased interest cost to the borrower versus what does the lender make on that? What might otherwise be just an extra point in premium on that $750,000 that they sell. So they make an extra $7,500, but it costs the borrower tens of thousands of dollars over the life of that loan. That's kind of my take on it. And I look at it and say, hey, if I walk away from that loan with 10 points in a premium, but the borrower gets to save quite a bit in interest over the life of that loan, then everybody wins.
I like that you broke it down that way. And that makes sense to me because just so people understand, SBA lenders charge, they make money off the interest rate on the 7A program. There's not really a lot of fees or anything that goes to the bank. There's a small packaging fee, but like the way they make money is through the interest rate. So, the max interest rate on these loans would be prime plus 2.75%. And then you can sell the guarantee on a secondary market and earn a premium. And anything over, it's 12% now, Kevin, right?
Is it 12 or 10?
I thought it was 10 and they changed it, or maybe they rescinded it, but whatever.
It was 10 for as long as I've been doing it. Yeah.
I think it might have been a proposal, but anyway, you're splitting that with the SBA, which is what helps make this a zero subsidy program in many of the years. They earn fees. So the taxpayers don't have to pay, that's also good. But what you're saying is after a certain point, the rate, it becomes less profitable for the bank and just more profitable for the SBA. My point was that if you're charging a higher rate, your example was like 50 basis points. Well, what if it's like 1%? And what if it's, something where that example doesn't come into play where you're not splitting it, but what if you're providing some other value, for the higher rate? That's what I was saying, because if it's two exact things, if you're just looking at it as a commodity like money, and one is this rate and one's a higher rate, then you should, of course, go with the lower rate. And certainly I want the borrower to get the best deal possible, but there's other ways you can provide value through these loans, like speed to commitment, speed to close, taking on more risk, things like that, where it would warrant a higher rate. How do you view pricing at your shop? Like, how do you determine pricing? What is it based on?
You bring up a lot of great points, and I agree with everything you just said. And if I can summarize kind of what you said, is that you can't really have a one size fits all approach to pricing, right? Or structure. So that's kind of my philosophy on both of those things, pricing and structure. One of the shops I worked at, our credit policy, the first paragraph of the credit policy stated, you'll notice this isn't written in stone because it's meant to change. It's meant to change over time. And I think the same can be said with pricing and structure, is that you can't, or you shouldn't, in my opinion, just say, okay, we're doing a 7A loan and they're all going to be priced at 275 over prime, or they're all going to be priced at 250 over prime, or whatever the number is, so that we can maximize yield. My philosophy has always been that you look at any particular loan, figure out where you think it is in the market, what is a market rate for that loan, and then you price it accordingly. So, whether it's fixed or variable, I mean, we do some fixed rate pricing. I think that's one of the benefits of being in a community bank, is that we can do some fixed rate pricing. There is a relatively active secondary market for fixed rate pricing, not quite as active as variable, quarterly adjustable, obviously. But we do fixed rate pricing where appropriate.
Let's play a game. I just made it up. Do you have a piece of paper by you?
I do. Let me grab one. Hold on.
Okay.
I got to get a pen.
Yeah, get a pen. I'm going to describe a deal, and we're both going to write down what we think the market pricing is on that deal.
Okay.
And then we'll hold it up and see if we're on the same page.
All right.
Guy owns a gym in California. It's in rural California, so he didn't get crushed. He's relocating to Florida this is a real example, by the way.
Oh, jeez.
He's relocating to Florida to buy another gym with the real estate. It's a $2.5 million purchase, and the real estate is 75% of it. He's putting down about 10% on the real estate and 15% down on the business. So 25-year term, there's no seller financing. He's relocating. The other gym kind of runs itself, he says. And so we got gym, business acquisition with real estate, probably about 88% financing on the advance rate. Is that enough information for us to do? Where does the market price the rate at?
Yeah, I mean, assuming you're.
Oh, and the gym in Florida is actually grew during COVID. Like it cash flows every year, There's good
Existing gym.
positive
Okay.
trends. Yeah, the business is actually solid. They didn't shut down during COVID, even the 6 weeks here in Florida where we were supposed to. They just stayed open.
Okay.
So good trends, good cash flow. The guy's a good operator. Him and his wife are owner operators. Their other gym is doing well. It's really a clean deal all around. The only hiccup is like people have a stigma on gyms these days, but otherwise it's a very solid deal. There's also the relocation aspect in his other gym. But there's really, I think, minimal debt on that gym. It also generates excess cash flow. So it's a pretty solid deal. What do you think?
So yeah, as a someone with a little bit of a credit background, I'd probably be looking at the principles of that business and, what does their credit look like? What does their PFS look like? What kind of cash after closing do they have? Liquidity, that kind of stuff. I'd be looking at that before, either moving forward or putting pricing on him. I mean, assuming all that stuff's adequate, right? Let's just assume that that's adequate. 25-year paper. Now you're talking variable, right?
Well, hey, if you want to fix the rate, you fix the rate, man. You're in charge. And they do it. They have about 400,000 liquid and 700 plus credit.
All right, I'll show you where I would be. Where I would probably price that, most likely. You ready?
Yep.
You see that?
Oh, dang, dude. Yeah, see, we're way off. I don't know if you can see mine, but
yeah, 225.
225, dude. Yeah.
Yeah.
Well, guess what? I lost it, and they got. This is crazy. I don't even know if they're gonna get this, but they got 4.25 fixed for 5 years.
Okay, so prime plus 100.
Prime plus 1 fixed for 5 years.
Fixed for 5 years, and I don't have a rate sheet in front of me, but I just wonder where that would be on a fixed rate sheet.
It's a large bank, but I was surprised that a large bank would do that type of deal just because of industry relocation.
I think the reason why you might see a large bank do something like that is number one, does the large bank already have the relationship with the gym?
No.
So where they would see that business walking out the door from a treasury service perspective, et cetera.
Well, they would certainly want and get the relationship, I know, at a very minimum.
Okay.
I don't know if they have it currently.
Yeah, so that would be something where if they stood to lose that business, and maybe that was an important piece of business to them, maybe there were some nice treasury fees attached to that, et cetera, that they would not want to see that business walk out the door, and they might skinny down their rate. And then if they're a large bank that does not sell, if they portfolio that, let's look at what that yield is. So 4.25 for them today is probably somewhere between, maybe even as much as 100 basis points higher than what they're getting on comparable conventional owner occupied financing. So they might be putting stuff out on the street conventionally at 3.25, 3.5, 5-year fixed. You're seeing a ton of that on sub 4s is the norm now for conventional owner occupied finance. So from a yield perspective, they stand to make quite a bit more. And oh, by the way, they have a guarantee on it. They have a 75% guarantee, or even 90 if it was done during the stimulus.
No, it's 75, but here's my thing. One, are they going to get it done? And two, how long is it going to take? I mean, I was really jiving with this guy, and this one really hurt because I was working on a Saturday. It's an acquisition, so there's a contract, there's a deadline, and he's just like, I just want to get this done, get it done quickly. I said, you came to the right place.
Mm-hmm.
So I, within a matter of days, I write it up, I review it with my team, we put out a proposal. It's exactly what he wanted, structure-wise. I was upfront about my pricing, and he's just like, well, I'm waiting on another bank to see what they do. And I was like, well, okay, well, you can wait around for the other bank, I guess, fine. And then even another offer came through. And I'm like, why are we waiting around for all these banks? I thought you wanted to get it done. We just burned 2 weeks. And so he's like, well, with that one rate that I mentioned, he's like, I'm going to just stick around and see if this is real. And I was like, all right, fine. But like, I am more expensive because I'll move quicker. And that's just my go-to-market approach.
That happens. Happened to me earlier this year. We had a $5 million business acquisition loan here locally, and we lost it to a local bank. And the reason why I brought up, did they already have the business there, was the seller banked with a regional bank, and they saw it potentially walking out the door, and they came in and offered the guy, I want to say, it was a 90% financing deal on a very large business acquisition with not much in terms of assets, a ton of goodwill. And he got 4.15% fixed for 10 years or something like that on the deal.
I don't have a problem losing a deal to competition. They lose to me, I lose to them. We're friends. If I lost to you, I'd be like, good. Kevin's a good guy. I'm fine with that.
You even referred me a deal. We just closed it last week.
But do you ever run up against what we call stupid?
Oh yeah. Yeah. But you know what? Competing, if you're talking about competing on rate with stupid.
Anything. Could be structure.
What? Yeah, that's a non-starter. I mean, what is it they say? If you roll around in the mud with a pig, the pig gets dirty, and
you have a
he
lot of pig
enjoys it.
references.
Yeah, whatever.
You came to Bank of Central Florida, and
yeah.
This was, what has it been, about 9
almost
months?
a year. Yeah.
And did they have an SBA department when you got there, or no?
No, never. They did, or we did some SBA 504 loans along the way, and had the CDCs come in and talk to our folks about it. And we had done some 504s, but never had done 7A lending.
What made you go there?
People. So it's, our business, especially in the community banking world, it's a people business, right? We typically do and work with people we like and we respect. And the guy that was my boss at my former bank became the president of Bank of Central Florida, wanted to expand the bank. So our bank is based in Polk County in Lakeland. We've been around 14 years, and really wanted to grow the bank both in terms of geography and in terms of lines of business. So when he approached me with the opportunity to come over here and set up yet another SBA department in Tampa, and then have a bigger reach across the state of Florida into Orlando, over to the Space Coast, et cetera, I just thought it was a good opportunity for me to build something bigger over time and be part, more so be part of the bigger growth plan for the bank.
That's exciting. Building things is like my favorite part of what I do. You get to see it grow, and you get to kind of see your work and it paying off. So you came there. Now, are you just bringing the old Kevin Riffey playbook to this and redoing what you've done in the past, or are you going to be doing anything different in this venture?
I mean, obviously the thing that's going to be different is we have some pretty aggressive growth plans in terms of geography. So I've never had BDOs outside of the immediate area. So that's going to be different for me. I'm excited about that. I think that's going to be phenomenal. I mean, ultimately, if I were to put together a 2 or 3 year picture, we'll probably have 2 to 4 BDOs. We'll have, a dedicated SBA underwriter, and it'll be a much bigger shop than what I had in previous shops.
Yeah, because your last one, you were just in Tampa, right? And you had like one
BDO. We had to reach into Sarasota and into Polk County, but it was what I would consider the greater Tampa Bay area, and we had one BDO. That's correct.
Okay, so that last shop was like a small shop. This is going to be more of a medium-sized local shop by the end of if you get up to 4 BDOs. I mean, that's pretty solid. I mean,
that's the goal. We do have very aggressive growth plans. We had a pretty decent number put on us this year, and the number next year is more than double what we did this year. So,
good luck.
It's interesting. I sometimes wonder if I'm a glutton for punishment, because I knew this coming in. The guy that I came over here to work for, it was no different at the last place. So,
well, we can see about getting you some deals and helping you meet that goal. But
yeah.
Let me one question, then I'll let you go. Are you doing all 7A deals? What's the what loan ranges are you looking at? And are you doing both? Are you doing startups? Are you doing business acquisitions? Is it just real estate? Like what are you looking for?
Yeah, so the focus for our SBA department, our specific SBA department, is 7A, and we do the 504s also, but those are done with the commercial lenders. If I have a 504 opportunity come my way directly, I'm gonna hand it off to one of our commercial bankers in that particular market. But from the 7A perspective, we're doing stuff from say 250,000 all the way up to 5 million. And we're doing it across a broad range of industries. And we're doing all of those things you mentioned. They can be straight real estate loans. They can be change of ownership loans. They can be, some startups. We do have a couple of startups we're working on right now. But I think, kind of going back to earlier on in the conversation, we talked about looking at each particular transaction and seeing, does it fit? I've said kind of the way I look at things is you put all the ingredients in a mixing bowl, you stir it up, you put it in a pan, put it in the oven, and what does it come out looking like? And that's kind of the way I've done things over the years is, does it make sense? There are good restaurant loans, there are bad restaurant loans. There are good doctor loans, there are bad doctor loans. I mean, just because somebody's a doctor doesn't mean that they automatically warrant financing. So it's just a kind of a common sense approach to what we do.
Got it. Okay, good. So pretty much a generalist taking it deal by deal. I like it. Well,
Yep.
Kevin, thank you for joining us today. I had a fascinating chat with you. We didn't get into like a heated debate, which I thought would go viral, but it's okay. Next time.
Well, maybe we should spice it up next time. I don't know if you were feeling good enough to have that.
Well,
I don't want to kick you while you're down.
I don't even remember anything that we said. I blacked out. So
take some more Benadryl, you'll be fine.
All right, man. Take care.
All right, Ray. Thanks, man.
All right, that's it for this week. Don't forget to subscribe to the podcast so you never miss an episode of The Art of SBA Lending. And if you have any feedback or suggestions, email me at ray@artofsba.com. Until next time, ta-ta.